The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello everybody, this is Coach D with TackleTrading.com. I want to show you a really cool adjustment concept for a trade. Just a real simple trade. I've got long puts on US Steel. So let me kind of take a look at what we got here. Long puts, 57 days till expiration, 2 of them. The trade's up $465 and they're $27 strike prices. Now I'm going to go click on the Analyze tab here real quick. And if you look at the risk graph on this, these long put options, as you kind of get a look at the trade, the current profit scenario here, again, the current strike price where the stock price is sitting right there, that's our current profit zone. If the stock drops down a little bit more, you can make a little bit more money. If it rallies anything above 20, in this case 24.40, right here is the break-even point. If you kind of get a look at that, 24.40, that's where your trade starts turning back negative by expiration. And so what I'm going to do is show you how to make an adjustment here to completely eliminate the risk. Now, if we go back and look at what we paid for the trade originally, we can look back. We paid $2.60 for $27 puts. So I've already got the kind of the trade imaginary in there, but $27 puts paid for $2.60. So I'm going to go add a simulated trade. Here's the March options, same month. Here are $24 puts, which I could probably sell between the bid-ask spread for about $2.60. So I'm going to put in an order to sell those for $2.60. And if I can collect $2.60 for my $24 options, I've now officially pocketed what I put into the trade. So I have, in essence, a risk-free trade. Now, there's some real benefits to this, and there are some drawbacks to this, meaning what do we give up in doing so? Now, if we go look at the risk profile, I want to show you what happens to this trade. We get 2 of those contracts in there. And let's go back to the original trade. And what I have here is, let me spread this out so we kind of get a good look at this. I have the stock price, the current stock price, the break-even point at expiration, and if I do this particular trade, it's going to cap the gains at basically 24 to 27. That's 3 points times 2 contracts. So it'll cap the gains to $600. So when I do that, you'll notice it caps the gains right at $600. But what's really cool about it is it moves the profit zone down and eliminates all the risk on the trade. So let me kind of walk you through how that looks. So what I did is I went here and I set the break-even point at expiration, the current stock price, and the $600 profit, what it would take to get to 600 on the chart. So I went and I set those slices to the charts, and I go put that on the chart I want to go look at. And so here we are looking at that chart, and all it has to do is rally back up above 24 by expiration, and your trade goes bad. If you've ever let a winner turn into a loser, you know what I'm talking about. To make the $600 is not that far down. It only has to drop back down towards its current support to make more money. But then the question is well, I can leave the trade open. I don't have to do the adjustment. The idea is there's a big support zone in here, so I think it's going to keep going down. But at what point is this thing going to go back up? And my biggest concern is I got earnings coming out, and I just don't want to risk it through earnings. So if I can eliminate my risk and stay in the trade with the potential to make $600, I don't have to worry about riding through earnings. So bam, I sell that contract for $2.60. I have no risk in the trade. And what I just did is I brought the $600 profit zone from $21.80 some odd cents. I moved that all the way up to anything below $24. Anything below the strike price of $24 now makes your $600 free and clear, guaranteed, and you have no risk left in the trade. In fact, you cannot lose. You may not make all 600, but you cannot lose on the trade. So when I go set that slice to the chart, and we go back and look at that chart, now anything below that price point is guaranteed $600, whereas before to get that, it had to drop even further in price. So we can exit our trade, ride through earnings with no risk. This is just a basic adjustment, turning a long put into a bear put spread. There's no debit or credit associated with it because it ends up being net neutral at the end of the day. We spent $2.60. We bring in $2.60. Maximum profit's going to be the difference between the two strike prices, and anything below the lower strike is going to be guaranteed profits. So this is Coach D with TackleTrading.com showing you killer adjustments.
Isn't it time you got off the sidelines and tackled trading? Join our online community of active traders where we make it happen every day. Stocks, options, futures, and Forex at www.tackletrading.com. Get in the game.